Hi all, this is Imran here. I welcome you all to my YouTube channel. Today, our topic is mutual funds. Let us quickly understand what we are going to learn today. Today, we are going to learn about the introduction to mutual funds. So, what is mutual fund? How does it functions? We are going to discuss about advantages, the different types of funds available in the market, and the terms to remember in mutual fund terminology, and finally, we have a summary and disclaimer section to close with. To understand this mutual funds concept better, let me come up with an example. Let us assume there is a birthday event in my home next week. Now, what can I do? I can take care of entire activities right from the balloon decoration, room decoration, cake preparation, food preparation, snack preparation, organizing of events to entertain the people, and packing of the return gifts for the small kids. Now, I'm not so keen in effectively handling all these activities from my end. So what can I do? I can hire a professional event manager who can do all these activities on behalf of me. Now I have hired a manager and I'll just give him with the information that how many people are expected to attend the event. Now he will be responsible to taking care of this decoration, food, snack, cake preparation, planning of the events or activities which can entertain the people, and packing of the return gift to the people. Now this is the major difference between this stock market and the mutual funds. Now let me give one more example to understand this better. Now suppose you have invested 1,000 rupees in stock market and this 1,000 rupees has generated a profit of 100 rupees. Now this entire 100 rupees profit belongs to you. If this is the same situation in mutual fund, 1,000 rupees is invested and 100 rupees profit is generated, this 100 rupees profit is equally distributed among the number of people who pool the money in this mutual fund. This is a major difference between this capital market and mutual fund. Hope you understood the mutual fund concept better now. To keep it simple, so investors pool their money with the fund manager and fund manager invests this money in securities. The securities might be equities or debt instruments. So it will depend upon the objective of the mutual fund in which you are investing in, and these investments generate the returns and these returns are passed back to the investors again. So in a simpler way, say this is what mutual fund is. Below are the key advantages of mutual funds. Professional management. When you invest your money in mutual fund, you're pooling your money with a highly qualified investment professional whom we call as fund manager. He will invest your money in stocks or debt instruments based on the investment objective of the fund. Now, if any of this investment is going down due to market fluctuations, then fund manager will closely monitor those portfolios and make effective changes within the portfolio so that your gains are maximized and your risk is minimized. So, professional management helps your investment grow all the time. Number two, diversification. So mutual fund tends to invest in wide variety of market securities like stocks, debt instruments, treasury bills, so which we have been discussing from very beginning of this video. So what happens with the diversification is the loss in one instrument will be capitalized with the gain in another instrument. So this is the key benefit of diversification. Number three, low cost. For example, if you want to invest in stocks and you picked a highly recommended stock which is trading at around 3,000 4,000. Now, investing at 3,000 4,000 is of a high risk and many of the investors may not be ready to take that much risk, and many of the investments don't feel that it is a cost effective for them. Now, when you want to invest in mutual fund, the minimum amount that is required to invest is 100 rupees. Yes, you can start your investment from 100 rupees, 200, 500,000, 2,000, and so on based on your financial stability. Now you can understand how low cost effective the mutual fund investments are. Next, we have a flexibility. We have different kinds of funds available, like equity fund, debt fund, hybrid fund, solution oriented fund. So this flexibility will allow you can switch from one fund to another fund within the same fund house easily. For example, you have invested in equity fund which is performing very badly due to the market fluctuations. Now you can move this investment from equity fund to debt fund so that you are on a safer side. So this movement from one fund to another fund within the same fund house is what we call as a flexibility. And last we have tax benefits. Yes, there is one set of mutual fund which come up with a tax benefits. Okay, the investment in these funds will help you showcase them in this taxes so that you will get tax benefits under 80C. I will come up with a different video, a separate video on this tax benefit fund, which we call it as ELSS. Next, we learn about types of mutual funds. This fund differentiation is based on two parameters. One is structure of the fund and another one is investment objective of the fund. These six funds are the basic funds that we need to understand before we can explore more. Let us learn more about these funds. First, we learn about open-ended fund. So, what is an open-ended fund? The fund in which investor can enter or exit at any given point of time is called open-ended fund. These open-ended funds does not have a lock-in period. The investors can purchase or sell the units in these funds at any given point of time. The only thing that needs to be considered is whether there are any entry and exit loads for these funds. Confused on these two new words, entry load and exit load? Not to worry, we are going to discuss about them in later part of the video. Next, we learn about closed-ended fund. This fund is quite opposite to open-ended fund. The investors will be able to purchase the units only during new fund offer period. After that, these funds and units will be locked for the period of 3 to 5 years. This lock-in period will be clearly mentioned in the offer document. During this lock-in period, investor will not be able to purchase or sell any of the units in these closed-ended funds. Now that we have learned about different funds based on the structure, let us explore more funds based on the investment objective. First, we will learn about equity fund. So, what is an equity fund? This equity fund invests money in the stock market, nothing but stocks. That means the money pooled from different investors like you and me in this equity fund will be investing in the stocks. These equity funds will relatively come with a high risk, at the same time they will generate high returns. These funds are suitable for the people or investors who are seeking the capital appreciation in the long term. These funds are not suitable for the speculators or short-term investors. We do have a different subcategories under this equity fund, which I will be coming up with a separate video. Next, we discuss about debt funds. These debt funds invest money in the debt instruments available in the market. These debt funds relatively come with low risk and they will generate low returns as well. Next, we have hybrid fund. What is an hybrid fund? Hybrid fund is a mixture of both equity fund and debt fund. These funds invest in both stocks and debt instruments. The proportionate in which the investment is made in equities and debt funds is clearly mentioned in the offer document. These hybrid funds come with relatively a moderate risk and will generate the moderate returns. And finally, we have solution oriented fund. What is a solution oriented fund? As the name suggests, these funds come as a solution for different challenges we have in our life. What are those challenges? Our kids' education, our kids' child's marriage, purchasing own house, or planning out for a long vacation. So these funds help us to procure money for these activities, right? How do these funds help us? In what way? So based on this objective of the fund in which you are investing, the fund manager will build a solid portfolio so that the market fluctuations will not have any impact on your investment. Now, let us learn about the terms that we use in the mutual fund terminology. Subscription. What is subscription? It's nothing but the purchase of a mutual fund units. So purchase is called subscription. Redemption. What is redemption? Redemption is nothing but the selling of the mutual fund units. Net asset value, NAV. So what is NAV? The current value of each unit on a given day is denoted as NAV. Now, entry load. What is entry load? The fee charged from the investor while purchasing units in any fund is called entry load. Exit load, opposite to entry load. The fee charged from investor while selling the units in any fund, right? Lump sum. Lump sum is nothing but the one-time investment made in any mutual fund. SIP, systematic investment plan. Systematic investment plan is a systematically investing a fixed amount at regular intervals of time in any of the fund. For example, I want to invest 500 on first of every month in one fund for a long term. That we call it as systematic investment plan. SWP, systematic withdrawal plan. When you want to sell all the units you have two possible scenarios. You can sell all the units on one go, or you can opt for systematic withdrawal plan. So how does this work? On first of every month, I want to sell 50 units in a regular intervals. Systematic withdrawal plan. Now we have systematic transfer plan. So as the name suggests, if you want to move your investment from equity fund to debt fund, instead of moving all the funds in one go, you can systematically move certain amount of funds at regular intervals from equity fund to debt fund. That we call it a systematic transfer plan. Now, expense ratio. Okay, to understand it better, let us come up with one example. Okay, there is a set of 10 people who pool their money 100 rupees each with the fund manager. So 10 into 100 is 1000 rupees. The fund manager has invested these 1000 rupees in stocks and it has generated a profit of 100 rupees. Okay, now what happens with these excess 100 rupees that has been generated as profit? This profit will be not equally distributed among the 10 investors based on the amount they invested and based on the units they hold. Now, will the fund manager distribute entire 100 rupees among these 10 investors? No. For maintaining your portfolio and taking care of your investment, these fund manager will charge some part of your profit that they will call as expense ratio. In general, this expense ratio will vary from 1% to 3%. Finally, we have reached the end of the video with summary and disclaimer section. So the summary of the session is: the mutual fund is the best investment tool available in the market for investors with no knowledge or partial knowledge about the capital markets and seeking the returns in the long term. Now, the disclaimer is, I hope each and every one of you knows about this. All the mutual fund investments are subject to market risks. So please read the offer related document carefully before investing. I would like to thank each one of you who has watched our video from the beginning. Hope this session has helped you in understanding the mutual funds concept better. If you like the video, please hit the like button and share the video with your friends and relatives. And most importantly, please do subscribe to our channel. This will motivate us to come up with more interesting topics like this to enhance your skills and knowledge levels. Thank you. Thank you, everyone.